Good afternoon, everyone. Thank you for joining this webinar where we will be reviewing the last month, how market did, how a lot of passive indexes did, what were the major movers. We'll also talk about international market in bit more detail, and we'll also talk about commodity segment. The idea is to obviously cover that within 30 minutes or so, and remaining time we will use for any questions which you might have. So like every month, we typically do this webinar on the first working day of the month. We first review what has happened in the domestic market from a segment, sectoral, and thematic performance point of view. So last month has been sorts of a bit of a mixed bag. Market sorts of consolidated in terms of performance. As you can see, Nifty only gave a return of 2% in last 1 month. If you look at mid cap and small cap, the performance was a bit more heightened. Mid cap moved up by almost 6.5%, whereas small cap moved up by almost 9.6%. So, large cap remained co- on almost a level basis, just moving up by 2%, sort of consolidating the gains, whereas mid cap and small cap have moved up by 6.4% and 9.6% respectively. This month sorts of continued the market recovery, which sorts of started around second week of April, after the Trump paused the tariffs on multiple economies, including India, and the 12-month return of Nifty since then in last 3 months has been around 12%, which is pretty good recovery. For Nifty Next 50, interestingly, is around 17% because the Nifty Next 50 fell more also. If you remember, right, it was down around 25-27% at one point in time in March. Mid cap is up by 19.2% in last 3 months, whereas small cap is up almost 22% in last 3 months. So from a segment point of view also, whatever fell the most has sorts of recovered the most also. So we are seeing a very healthy sorts of recovery, or rather have seen a very healthy recovery all throughout the market, be it be large cap, mid cap, small cap, and even the next 50 segment. Now, from a sectoral point of view, we'll first talk about BFSI, because that has been one of the key drivers of recovery in the large cap segment. Financial services this month has sorts of remained flattish. You can see BFSI only giving 1.6% return, but the 3 month period has been good, 15% return. Bank again flattish at 1.4%. 3 month return has been around 15.5%. PSU Bank obviously is something which has sort of stood out within the banking and financial, giving almost 7.4% return, and 3 month return being almost 24%. That also goes with the fact that that PSU Bank segment also fell the most when the market corrections took place early this year also. Flattish performance from private banks in last 1 month. Energy, something which has done well, 5% positive returns. 3 month return around 20% or so. Commodities, oil and gas, power, all flattish. Metals has done well at 7.1% return, taking 3 month return to almost 12%. So metal has been sorts of a late participant in this recovery rally. Now sorts of most of the recovery happening in last 1 month or so. One very interesting obviously has been how well manufacturing and especially capital goods have done. Capital goods have given a return of almost 13% in last 1 month, uh, taking the 3 month return to almost 29%. A lot of that rally has been also because defense has done really well within the capital goods segment, right? So defense doing really well has propelled the capital goods, one of the outperformers within the sectoral indices. Healthcare care has remained flattish. Again, 3 month return 11.5%. And again, you can sorts of co-link a lot of that with the fact that healthcare sorts of never corrected so much also during the first 3 months. And if you look at consumption, obviously that remains still one of the key concerns, right? If you look at earnings data also, from a consumption point of view is still not very good. So India consumption flattish again this month at 0.8%, whereas 3 month return is around 12% or so. And then we move down to auto, did somewhat better at 4.6% return, 13.9% return in last 3 months, right? If you within consumption, if you take out FMCG, it gave a negative return of almost 1.4%. So within consumption segment, FMCG has been a dragger, right? As you can see in the index performance, even 3 month return of FMCG is below 10%. Again, from an infra, gave a return of almost 2%, 3 month return of almost 17% or so. Again, one of the outperformers were media also, which gave a return of 13% and 3 month return of 23%. So if I highlight couple of sectors which have done really well in last 3 months, very most talked about obviously has been financial services, but apart from financial services, in fact surprisingly, PSU bank 24% return, capital goods 28% return, media almost 23% return, and PSU space as a general, because all of these defense centric PSU has done really well. That has almost 24% return in last 3 months. Now looking at alpha and low volatility, alpha has sorts of recovered quite well. Right, in 3 months, it has given a return of 18.4%, which typically sorts of makes sense because first, whatever fell the most has recovered the most, right? That is the trend that we are seeing, right? People have pounced to opportunities in terms of price correction, and bought back a lot of stocks which have fallen, because to be honest, earnings haven't justified much of the buying. As you can see in alpha, 18.4%, hence sorts of illustrate the fact that a lot of from a pricing point of view, buying has happened based on wherever corrections had taken place. And also it just illustrates the kind of behavior which alpha momentum has, which does well when market sorts of performs better. Having said that, I'll just like to point that alpha typically does well when market has a longer bull cycle, and typically not so much in the correction phase. Low wall, from a performance point of view, remain around 10% in last 3 months. FMCG, etc., being a key dragger from a performance point of view. Now, very quickly from 52-week high, and this you can see in the column which is next to 3 years. It is just highlighting how sorts of still at what correction these indices are trading. Nifty is almost down 6.5% from its 52-week high. Next 50 around 14%, right? Mid cap 6%, small cap 9.6%. This is very interesting that next 50, which is a large cap 51 to 100 ranked stock, are present in this index, that is still down 14%, whereas mid cap and small cap is down 6 and 9.6% respectively. Financial services are roughly trading at all-time high levels. So is bank. Again, from a deep correction point of view, energy, oil and gas, power, etc., still below 20 to 20% plus from its 52-week high. And as we go down lower, you still see media around 20% lower, as well as IT still around 20% low from its 52-week high. On the just right side, you can see how sharp has been the recovery also, right? Small cap is up by almost 27% from its lows. Mid cap is up by 22% from its lows. Nifty is up by 15% from its lows, and next 50 is almost 8 19% from its low. So we have seen a very, very volatile initial 5 months, when first 3 months everything was going wrong from a market point of view. Earnings were not good. Uh, there were tariff issues which are looming. Geopolitical issues were obviously raising concerns. And I think a lot of that has sorts of flipped, and the major flip has been obviously uh, the tariff issues, which we feel that might play out relatively okay, right? It seems that Trump is out there to do the uh, do as many trade negotiations and agreements with as many countries as possible. Now, looking at valuations very quickly, Nifty is right now trading at around 21.5, which is around 10% premium to its 10-year average. So Nifty is at a premium of around 10% or so. Mid cap is around at 16%, and small cap is roughly around at a 30% premium. From a valuation point of view, BFSI still looks attractive. For example, financial services is at a 14% discount. You can see that in the last column, whereas bank is roughly at a 4% discount, right? Apart from that, from a valuation point of view, all across the segment, all across the market, things look on the expensive side. So that is one thing which we should be obviously cautious about, that the story which the concerns which we had around early Q4 of last calendar year is sorts of have returned back, and we are again seeing a rich valuation across segments. Uh, Before I talk about stock level performance, very quickly, let's see what is happening on the international front. And this I'll probably, from an earnings point of view, I'll go in more detail, because uh, Indian earnings and have been covered by a lot of commentators. So I'll talk more about US earnings, because if you look from a performance point of view, FANG continues to do really well. Top 10 big tech companies of US right now, from a 52-week high, it is only down 2%. So it is roughly around its all-time high. In last 1 month, it has given a return of almost 12% compared to 9% of Nasdaq 100. In last 3 years, FANG has given a return of 38% compared to 20% of Nasdaq 100. Nasdaq 100, which itself is a tech-centric portfolio, it simply highlights how well top 10 or mag 7 companies have done in US market, not only from earnings point of view, uh, results point of view, but also from stock performance point of view. So US markets have sorts of recovered fairly well. Nasdaq right now, it's only 4% down from its 52-week high. Again, a while back, when Trump was causing all sort of confusion, it was roughly around 20% down from its 52-week high, almost entering the correction zone. So good to see recovery in US markets as well. In last 1 month, Nasdaq is up by almost 9.1%. S&P 500 also is up by 6%. It's again almost 4% off from its 52-week high. Now, interestingly, I think this is the most interesting data. If you compare the PE, still, still, FANG and Nasdaq. FANG is at a 13% premium compared to its 30-year average. 10-year average. The PE is roughly around 34. Nasdaq is at 21% premium. So current P is around 28, 10-year average is around 23. And if you look at S&P 500, that is again at a premium of 19%. So right now the P is around 23, 10-year average is around 19. Interestingly, from the data, it looks that FANG is relatively more sorts of better place to be, even from a valuation point of view. But if you look at earning projections, while last several quarters earnings have been very good for Mag 7 companies, going forward that is expected to get muted, or not muted, maybe come back to what a broader benchmark averages are. Now, if you're looking at China, we are looking at Hang Seng Tech. In last 1 month, it is up only by 1%. I think one of the key issues with China remain first is whether U.S. China deal is going to happen, and how quickly that is going to happen, because one of the biggest laggard for China is obviously the internal consumption. The domestic consumption hasn't come back. So the internal issue remain, and I think a lot of performance out of China will sort of depend on the US China deal also. Having said that, look at the PE. 17.7 PE is of Hang Seng Tech, and just 11 PE is of Hang Seng Index. And when you're looking at Hang Seng Tech PE, just imagine a lot of companies which are also loss making also. So if you only would have compared positive PE, then that ratio probably would have been lower. So I think from a valuation point of view, it is still interesting. It still looks attractive. If you compare it with historical valuation, market looks cheap. But the two concerning issues remain, that Chinese government have done taken a lot of policy measures, but market expects more to revive the domestic economy. Let's see if that happens or not, and also from a US China deal, whether that happens or not. So again, from a China allocation, I'll continue to remain cautious, depending on how both domestic consumption numbers are, and as well as how US China deal takes place. Now, very quickly on the commodity side, gold is roughly around 3,300 levels from a dollar point of view, right? Look at the third row, and the silver is around 33. So it seems that gold has consolidated around this 3,300 levels as of now, because that is the price range which we are seeing since quite some time. The YTD and 1 year number still looks pretty good for gold. Uh, See, for gold, lot of movement will depend upon the fact on how this entire tariff issues pans out. Whether are we going to see quick deals between major economies like US Europe, US China, US India, US, Japan, etc., or are we going to see a drag in this also? Also, are we going to see any escalation of geopolitical of issues which are happening in Russia, Ukraine, and Middle East? But most importantly, whether central banks continue to buy gold. That is, I think, one big factor which I think is not emphasized enough, that the amount of buying which central banks are doing for gold is something which has supported the price. So if that continues to happen, we can see gold continue to do well. Having said that, I will right now invest in gold only from an asset allocation point of view. I will not over allocate. Silver at 33. Silver is very closely linked with how China market is doing. It's very key component of industry, especially solar. Solar cells, EVs, etc. So if numbers start coming out good from China, that is something which will put silver at a good sorts of springboard. Gold silver ratio also looks favorable towards silver, but obviously, like I mentioned, that it depends a lot on how China is going to do. So any deal between US and China is going to be very positive for silver also. From dollar index at 98.9, I think we have discussed in last two calls that Trump administration seems to be okay with a weakish dollar around 100 or so, and that seems to be the case right now. The 52-week high was around 110. Right now it's around 99. I think that is where probably dollar is going to remain for some time. Crude obviously is around 64.3. Again, depends a lot on how several geopolitical issues pan out. Now let's talk about stock drawdown, and this particular slide simply illustrate how sorts of diversified the recovery has been, right? So let me just quickly try to explain some of the table. It can be a bit confusing. So right now, if we look, and this is just talking about stocks which have fallen, right? So there are in last 6 months now, there are 285 stocks which have fallen by more than 10%. There are 128 stocks, and this is out of 750 total market cap index. So out of 750 stocks, 285 have fallen more than 10%. 128 have fallen by more than 20%. 46 out of 750 have fallen by more than 30%, and just 3 have fallen more than 50%, right? And what has driven that is a very phenomenal recovery which we have seen in the market, right? So just look at 1 month data on the table right adjacent to this table, which is highlighted in green, that in last 1 month itself 327 stocks have moved up by more than 10%, 135 stocks have moved up by more than 20%, 55 stocks have moved up by 30%, and 6 stocks have moved up by 50%. If you again look at a 6 month data number for 30%, 50% and 20% is pretty sorts of healthy. So it just talks about that. If you remember, by till March end we were talking about a very heavy broad based downturn in the market. In last 3 months we have seen completely opposite, that how well stocks have sorts of recovered. If you compare it with 52-week low, the answer will be more surprising. There are 228 stocks are more than 58 which are more than 50% up from its 52-week low. 228 stocks, which is phenomenal number. Again, if you are looking from a 52-week high, there are no stocks in Nifty now which is more than at 50% discount. Only 8 at 30% discount. In next 50 the number is bit higher, but just at 10 in total market, that number is around 256. Again, from a recovery point of view, the adjacent table talks about how well sorts of recovery has taken place in Nifty 50, next 50 and total market cap. You look at next 50 recovery, there are 4 stocks which have recovered more than 50%, 9 stocks which have recovered more than 40%, 21 stocks which have recovered more than 30%. So it's a very sorts of spread out recovery which has happened. And like I mentioned in the very start, it seems like whatever has people have jumped for price correction, and whichever has corrected more has sort of risen more also. Now, yeah, this is performance of how Nifty 50 portfolio has done. So what I'll do, I'll just talk about Nifty 50, Next 50, and Alpha 20, Alpha 30, which will also give you a bird's eye view how Momentum 30 has also done, because a lot of people might have invested in Momentum 30, which we don't have, but the competition and other peers have. So if you look at Nifty 50 portfolio, in last 1 month in Nifty 50, the best performing stocks have been L&T, which is up by 9.6%. Right, as I go down, you see Tata Motor up by almost 9%. Bharat Electronics up by almost 24%. Yes, driven by the fact of defense PSU companies doing really well. You see Adani Port up by almost 14%, Geo Financial up by 10%, and then the bottom stocks, which to be honest does not contribute much in terms of return, but still Adani Enterprise up by 10%, and Hero MotoCorp up by almost 12.8%. So this have been the last 1 month performer. If you're looking at almost, let's say, a 3 month performance, again BEL stands out at 56% return. You look at Adani Port, almost 35% return, Geo Financial at 38% return, HDFC Life Insurance and SBI Life Insurance at around 26% respectively. So that is how, from a performance point of view, uh, stocks which have moved up the most in Nifty 50. But just look at from a 3 month point of view, which stock has impacted the most, because impact is dependent on कि stock का weight कितना है index में and returns कितना है. So ICICI, which is the second largest stock in Nifty now, has given 19% return. That has 9.1% weight. Reliance Industries have given almost 16.6% return, has 8.6% weight. Infosys has performed really poorly. I think has is the biggest laggard on the index. It is down 8.5% 3 months, 5% weight. Then you see Bharti Airtel giving positive return of almost 17.3%, has around 4.4% weight. So banks, which are obviously the heavy component of Nifty 50 index, has done well, and I think that has sorts of supported the fact that Nifty has given double digit return in last 3 months. If I'm looking at next 50, here obviously again we'll talk about just 3 months performance because of lack of time. So you see that the highest weight in Nifty Next 50, which is the bottom 50 large cap stocks, highest weight is Indigo, as expected, has given 18% return in last 3 months. HAL has given 61% return in last 3 months. It has a weight of 4%. Divi's Lab around 20%. So 3.6%. So top three stocks have done really well. Then you see TVS Motor, Britannia Industries, Bharat Petroleum, Godrej Consumer, Indian Oil, GAIL, DLF, REC. So all again Bank of Baroda, etc. See a lot of PSU components and components from energy, etc. Done really well within the next 50. Resulting in a return of almost, I think it was around 17% or so in last 3 month period. So we see a reasonable performance across these segments, right? I think the only negative has been Dabur India in last 3 months at 1.5% negative, and Swiggy, which is negative by almost 0.2% in last 3 months. Others have been a positive contributor to the Nifty Next 50 data. Now, Alpha 30 is obviously, as people might know, the top 30 stocks based on Jensen's Alpha stocks, which have created Alpha, and that's this product also has sorts of recovered quite well. Sorry, this is not sorted as per the weightage, but you can see that the highest weightage is BSC, which has done quite well, right? 1 month return almost 30% or so. Again, Divi's Lab is around 5.2%. 197 is around 5.2%. You can see at the bottom of the table. So you have several stocks which have done really well. But let me point out a couple of them. BSC, like I mentioned, has a weight of now around 8% in the portfolio, has done really well in last 1 3 month. You have Solar Industries at again return of almost 86% in last 3 months has a weight of around 4.2%. 197 communication around 30% return last 3 months or so. So again, a reasonable performance from Alpha, though not as good as, to be honest, I would have expected. I think here we can see probably a bit more recovery and strong performance if we see a sustained rally in the market, right? This is just a recovery. Also, one very important thing which people should note is that all the smart beta indices, not all, but alpha, mid, small cap, momentum, etc., will undergo portfolio change in June rebalancing, which will be done by National Stock Exchange. So, portfolio will change quite a lot from what you are seeing here right now. Now, very quickly on the market side, on the FII, we saw a net inflow of almost 20,000 crores in May 2025. So the inflow was, I think, around 1,000, fairly low in April. It has followed up with a reasonable inflow of around 20,000 crores in May itself. So seems like FIIs are also sorts of returning a bit and have invested in last 2 months. These 2 months have been the only 2 months when FIIs have sorts of put money into the market. Otherwise, you are seeing a reasonable amount of outflows from the market. Now, from an earnings point of view, I think the earnings were disappointing as expected, right? I think you can take it in two ways. Nifty 50 giving a very low single digit earning was disappointing but was expected, right? And that's why market hasn't sort of reacted adversely, because the poor earnings of this quarter was expected, and that you can see from this quarter on quarter graph, right? What I have done is that uh, Q1, Q2, Q3, Q4 of this year, and Q1 of next calendar years, I have plotted in terms of what is the earning estimates from Nifty in these quarters. So the current the quarter which we just had, which is highlighted in blue, as you can see, and then subsequent quarters are the ones above. As you can see that most of the quarters earnings were reduced, right? And that was one of the trigger point, if you remember, of deep corrections which we started seeing in the market, right? You can see Nifty in white from index, and started correcting when the earning projections started going down, right? And we can see that blue line, which is this one, obviously uh, earnings were a low single digit as expected. And for the other quarters also, we are not seeing sorts of earning recovery. Some minor recovery which we are seeing for for March ending quarter next year, but nothing major. Earning continues to be a concern for the Indian equity market. Even when we are looking from a CY estimate point of view, you can look. This is 24. The blue is 25, and this one is 26. The earnings which were revised downwards continues to remain so for 25 and 26 estimates. So earning obviously continues to sorts of remain a concern on a broad market level. Um, this is the graph which of gold and silver, right? I've already mentioned earlier that silver is very volatile, continues to get linked with industrial applications and how well China is doing. You can see the flip flops in silver performance, right? And silver is in blue. This is the scale for silver. It moved up, but again, we are seeing a very sorts of range bound movement in silver. I think inflection point will come if there is a US China deal and this trade issues get resolved. For gold, obviously, you can see that this has moved up too soon, too quickly, and that is why probably right now at 3300 level, which is still down from almost 3460 or so, which was one of the highs of gold. Uh, it is lower than that level, but I still sorts of not over allocate, but continue to obviously allocate from an asset allocation perspective from a long term point of view. I think gold will depend a lot on how obviously geopolitical issues get sorted and central bank behavior also, which has propelled the price of gold in last 2 years or so. In terms of yields and DXY, I've already talked about DXY. The 2 year yield remains around just below 4 right now, and the 10 year is roughly around 4.44. So 10 year has sorts of gone down a bit recently from a higher of around 4.6, 4.5. Now, very quickly, from an earnings point of view, like I said, that I won't spend time on talking about Indian corporate earnings, but rather I'll show a slide on US US earning. So please excuse the slide header. It's obviously not correct. Yeah. So earnings in US market has come out really well, right? If we are looking from a data point of view, 98% of S&P 500 companies have reported the results, out of which 78% have reported EPS above estimate. So they have uh, outperformed what market was expecting, which is higher than the 10-year average of 75%. Now, in aggregate, companies are reporting earnings which are 8.2% above estimates, which is above 10-year average of 6.9%. So earnings have come out well. If you look on the left hand side, the graph simply illustrates that the top performing sectors in terms of uh, exceeding the market expectations has been healthcare, communication services, information technology, industrial. So again, highlighting communication services and IT, right, which is the mega segment which drives the US indices, especially Nasdaq and Fang Plus. So that segment has done really well. You're seeing a surprise limit of almost 87, 88% there. Uh, Also, if you compare on the right side of the chart, if you look and compare the performance of Magnificent Seven, which is the Max 7 companies, now another name of Fang Plus companies, including Nvidia, which is referred to, and compare it with other 493 companies, you also see the diversion also in terms of how good they are doing. For example, Q2 2004, these Max 7 companies gave a earnings growth of 35% and 30%, then again 30%, and this previous quarter around 27%. So near about on an average 30% growth in last 4 quarters, which if you compare it with other 493 companies around 6%, 2.6%, 14%, and 9.4% respectively. So earnings growth have of Max 7 is stupendous, right? But going forward, the expectation is that this earnings will sorts of come down to more like the market average. So next quarter expectations 14%, then 9%, then 10%, 10%, whereas other 493 companies will sort of move up and will merge around 10% earnings growth in Q1 2026. Also, one very interesting thing, which is as per expectations, is that all these trade issues have sorts of made analysts reduce the EPS estimates for coming quarter as well as this financial this calendar year also. So sorts of Q2 earning estimates have decreased by 4%, and for the CY25 the earning estimates have decreased by 3.5%. Now, last two slides, in fact, last three slides now on passive market. This is the entire AUM spread as well as the inflow data. So this is the AUM, and then March inflows, April inflows, and the inflow of last 1 year. ETF in total is now 8.7 lakh crores. Index is now 2.86 lakh crore. Total is around 11.6 lakh crore, which is roughly 16% of the overall mutual fund industry. As expected, Nifty and Sensex are the top uh, uh, indices in terms of AUM. Uh, but the other segments like Smart Beta, you can see in ETF captures around 11,000 crores, in index captures around 30,000 crores, has been very sorts of upcoming segment. Now, from an inflow point of view, just couple of points. Uh, Gold has seen an outflow of almost 880 crores in April, which was interesting, but I think sorts of expected, because profit booking after gold has run up so much was something which we expected to happen. So gold, which has seen almost inflow of 15 point 4 thousand crores in last 1 year, saw an outflow of 880 crores. On a on complete flip side, silver, which now people are sorts of punting on, like I mentioned, that gold silver ratio is favorable in for silver right now, saw an inflow of almost 1100 crores, taking the 1 year net sales to almost 8.5 thousand crores, which is interesting that people are sorts of taking position more so on the silver side in last 1 month than the gold. As per expectation, I think lot of people have done profit booking on the gold side. On themes, we saw outflow out of IT. As per expectation, IT has not done well. CPSE and Bharat 22 outflows probably could have been justified by the corrections which have sorts of taken place. Maybe people were moving out of that particular segment and investing in other segments. So yeah. Apart from that, last slide, that we have almost 51 passive products right now, a mix of ETFs. We have fund of funds who does not want to invest in ETF and who do not have a broking account or demat account. You can use the fund of funds. We have index funds also. Now, most of the uh, plain vanilla simple offerings are the lowest cost in the market. Our mid cap bank ETF, IT ETF, liquid ETF, gold ETFs, liquid ETFs, etc., are the lowest cost product. And if not the lowest cost product, they are around the lowest cost product in the market. We have again very innovative offerings on themes, smart beta, etc. For example, in domestic broad base, we are the only ones who have multi-cap ETF. We are the only ones who have equity allocator fund of fund, which is just 10 basis point of fund of fund, which does asset allocation between Nifty 50, Next 50, and Midcap 150 based on valuations. It is a very good product. Comparable to large cap segments, because around 75-80% of allocation happens in large cap segment, remaining 20% allocation happens in mid cap segment through mid cap 150. ETF has done really well, so people who wants to take large capish allocation can look at equity allocator fund of fund. In themes, we have Select IPO ETF, which has done really well recently. We'll talk more about it in our ETF Spotlight seminar webinar this month itself. Then we have India New Age Consumption ETF, on which we are very bullish on. This is India's only consumer discretionary focused product. It does not contain FMCG, paints, auto ancillaries. It consists of autos, tours and travels, fintech, AMCs, consumer services, etc. Wherever you will invest your additional 1,000 rupees, those sort of companies will be present in that particular portfolio. Then we have smart beta offering. Again, would like to highlight mid and small cap momentum quality 100, which in last 3 months has given around 21% returns. In its recovery, consists of 50 mid cap stocks, 50 small cap stocks. India's only product which focuses on small cap and mid cap in this manner. Stocks are chosen based on momentum quality and liquidity metrics. Very quickly, if you ask me right now, I'll again talk about during ETF Spotlight. In broad-based offering, my go-to product right now is multi-cap ETF. If you're looking at ETF and an equity allocator fund of fund, oh sorry, total market cap index fund. If you are looking for an index option, so multi-cap for ETF, total market cap index fund for index fund. If you are looking for a smart beta offering, I think Alpha 30 is something where I can look at staggered investments for 6 month or an SIP in Alpha 30. Those are very good options for investment in smart beta products, staggered or SIPs, when sorts of index are still trading at a corrected levels. And the second product is mid and small cap 400 momentum quality 100. So these two products from the smart beta offering. And from the thematic offering, one product which I like to highlight is new age consumption, which like I mentioned, we as a fund house, we are very fairly positive on discretionary consumption. So that's it from me. I said that I'll finish it in 30-35 minutes. I've overshot by around 10 minutes. But if you have any questions, please post them in the chat box. I'll be happy to take them. There's someone wrote that chat is disabled, but I can see your message, so I'm not sure where the chat is disabled. So there is one question on, based on current scenario, which ETF is suggested to SIP. I think uh, I'll take three names, but if you're looking for core allocation, you can look at multi-cap 50 25 25 ETF, right? If you're looking for core allocation, if you're looking for sorts of a riskier but a more possibly more rewarding option, and you can stay invested for let's say 5 to 7 years, then look at Alpha 30 ETF and mid and small cap momentum quality ETF. So these are two options, but those are completely for different necessities. For core, look at multi-cap. If you're looking for somewhere where you want to invest small amount, you're okay with higher risk, then you can look at mid and small cap momentum quality or Alpha 30. So there's one question with Gauri. Multi-cap is with which name? It's called Mirae Asset Nifty 500 Multi-cap 50 25 25 ETF. what is your take on small cap ETF from a 3 to 5 year point of view? I think I'm fairly positive on multi on small cap space from a 5 year point of view. So if your horizon is 5 years, then you can invest in small cap. I'll do that in a staggered manner. There's one question on international offering, so I'll take it. So Santosh Kar is asking about international offering. Kindly discuss. I'm not sure whether you are asking from an investment point of view or an or outlook point of view. I think. Right now, there are very few funds in the market which are open for investment. If you're looking for ETFs, for example, all our ETFs are trading at a significant premium. So I'll suggest not to buy those, because if our FANG ETF is trading at a 15-20% premium, I think those levels are not justified right now from an entry point of view. So stay away. If there is any product right now uh, which is available at a fair valuation by our competition, then uh, probably see US market, especially right now, is at a higher valuation like we are. So I'll do staggered investment. I'll not over allocate. I'll just focus on asset allocation. So there is this that is something which I'll not go overboard on. China is something which I'll keep a keen eye on. If there is any positive movement on US China trade issue getting resolved, I'll prefer China over uh, over US allocation right now. There's one question on obviously investments for next 10 years in equity only. In equity only, if you're in looking for 10 years, I'll suggest multi-cap product and a mid and small cap product. So those two products for next 10 years is something which you can look at. There's one question by Devraj who asked that, what about hybrid funds and BAF? Yes, I think if you want to avoid any, if you want to relatively avoid any or reduce market risk and volatility, hybrid funds are good to go at these valuations. I think Virender, possibly right now, again, markets are at a higher valuations, right? Uh, I think staggered investments are something good to go with. Any concentrated big bets right now is something which is difficult to point out. But having said that, I'll focus on the segments which are still trading at lower levels from a pricing point of view, right? So I'll probably look at, like I mentioned, small cap segment, Nifty Next 50 segments, and from a theme point of view, look at new age consumption, where discretionary is something where I am sort of positive on. So there is a consolidated this PPT. Uh, we'll try to get it uploaded on the platform, but similar sort of presentations you can find for our products on our website. I've already talked about Hang Seng Tech. and FANG, so I won't be taking questions there. Uh, other countries' ETFs cannot be launched till SEBI opens the room. Uh, for Hang Seng, I'll probably hold uh, and probably not exit and see how the uh, the negotiations between US and China continues. But if I've already invested, I'd probably hold right now. There's one question on what is Nifty Total Market Index Fund. I think this is one of the most uh, basic uh, passive product which can be. I think it is the most true to label passive product. It invests in all 750 companies, which consist of 100 large cap, 150 mid cap, 250 small cap, 250 micro cap. If you're looking from a 7-10 year horizon point of view, we know that small cap companies will grow bigger, mid cap companies will grow bigger, micro cap companies will grow bigger. So this is an index which will take care of everything, right? A while back, micro cap was only 1% representation. Now it is 4%, right? So if micro cap and small cap in terms of size grows, this index will be future ready, right? So total market is I think the best total label passive investment which you can have in Indian equity market, right? I think there are a lot of questions. Just let me pick out couple of them. So the market does not have contra ETF. There is value ETF in the market. We don't have it, but the peers, couple of some peers have. See, there's one question which talks from a valuation point of view, which ETF is good at this time for 3 to 5 years. See, in my very initial slide, I talked about that from a valuation point of view. Nothing sorts of looks uh, very attractive, right? Apart from financial segment, which is still trading at a reasonable valuation, or in fact at a discount. Apart from that, you don't see any segment where at a broader level which is at an attractive valuation. So what I'll do from a 3 to 5 year point of view, like I mentioned, that if you can from a 3 to 5 year, I'll just take it as 5 year, right? If you're looking at 5 year, then probably because of correction, mid and small cap is one product we I can look at, and also next 50 is one product which I can look at because the corrections have taken place. If you want to play safe for core allocation, you can look at multi-cap ETF. I'll just take two more questions. So there's one question which talks about smart beta deliver good alpha. See, it's a great name given to a good idea, but smart beta product does not mean that they will always be smart. They just target a certain behavior. So a momentum which is smart beta product will typically underperform in when market cycles are changing, when there's a shift in market phase. Similarly, quality will underperform if BFSI is doing well, because quality is biased against BFSI from stock selection point of view. So smart beta simply, I think, factor products, factor investing is a better true to the label name than smart beta. So smart beta is all about basically targeting and capturing a factor, and then obviously hoping that your portfolio and that particular product performs how a certain factor performs. So there is no ETF for microcap, but there is an index fund for microcap, which if you want, you can check out. Yeah, I think I've taken several questions. If you have any questions remaining, please uh, uh, send it to us on mail or contact us via RM, and we'll be happy to answer more questions. So that's it from me. Please keep joining our webinar. The next webinar will be uh, on select products which we believe are good from an investment point of view in current market scenario. So that segment is called Spotlight ETFs of the month. That will be the one of the upcoming webinars. Also one of the webinars which we are doing, because I saw several questions which were talking about. Uh, which were talking about global funds. So we'll be doing a webinar on global funds also pretty soon. So let me quickly tell the dates also. On 9th of June, we're talking about uh, thematic passive funds, and on 16th of June, we're talking about Spotlight ETFs of the month. So if you're interested to know more about certain thematic products, please join us on 9th of June. If you want to know more about uh, the go-to ETFs in current market scenario, please join us on 16th of June. So that's it from me. Thank you for joining this webinar. Hope you have a great day and great weekend ahead. Thank you and goodbye.